Hello, guys. I trust you are all well, and I'm looking forward to the session that we got lined up. Someone asked me that just yesterday where I broadcast from. I'm in Johannesburg, South Africa, and beautiful weather out here, except we're presently going through what we call power cuts and load shedding. But be that as it may, we are ready to get started. Now, I want to just talk through a chart that's on my trade execution list. And when something is on trade execution, what that means for me is that I'm looking for ways to get into the market. So what I'm going to be talking about is the Hong Kong 50, the Hang Seng 50. But before I do that, I'll come back and talk to Jason. Before I do that, let's have a quick look at what's presently happening across all the 7 charts. And I can tell you what I have on my watch list and what I don't have on my watch list. So presently, for the guys who were in Jeff's show yesterday, I was talking about how I prepare for the weekend. We have touched on it briefly before. So just for clarity's sake, then when I go to the different charts, we're going to see it. So you'll see these thick blue lines. Okay, they simply indicate for me, this is the low of last year, and this is the high of the present year. Okay, that black one. So low of last year in the blue, high of last year, and we just pipped above it just as we got into the new year. Okay, somewhere near, we just went above it, but we quickly came back beneath it. So if on the euro versus the dollar, what it means is that we presently have what looks like it's going to be a slight inside candle because of that pip. It's not completely inside. But this line here is a 50% of the trading range of last year. Okay, low of last year, high of last year, 50% of it. So the market is really being drawn down to the 50% level, which also, as it turns out, is our presently low of the high on the euro. Now, so we are on the daily chart. Guys, feel free to pop any questions you want in the question box. So whenever I now have a chart that's transitioning from just a watch list to actual trade execution. That's when I put my highs and lows, and you see I don't have any low of yesterday. That would have been the red line, or high of yesterday here, because we've come out of this outside candle. So yesterday, when I was looking at it, I was expecting that we have a false breakout, which it did, and expecting a bull candle, end up as a bear candle. False breakout. Why? Because an outside candle is a trading range, a large trading range. So any trading range you buy from the bottom, sell at the top. That also influences my thinking on the Hong Kong 50, which is where I'm looking to see if something sets up for me to actually trade. But the bears failed, so the bulls failed to control the candle right from the bottom of the trading range. They went to the 50% pullback and they were repulsed, but the bears also failed to close beneath that candle. So trading range price action failed breakout. I don't have it on my watch list for today. Wait to see what we get out of the day. So euro is not on my present watch list. Gold. Again, so you know, just this macro view is just to emphasize again, just in fact not to emphasize, so that you can keep it at the back of your mind. Up at the top, high of previous year, the blue line at the bottom, low of the year. These black lines indicate where we have clarity, the high of the present year, low of the present year. Dotted blue line, as you can see, that's a 50% pullback. 50% midpoint of the range of last year. It's important just to kind of crunch things up and have a look at it and see if at all because the 50% of any trading range or any breakout is a powerful magnet. See if at all the market has been drawn to that. We've seen that on euro, we've seen that on gold. You can see how price is just at the 50% level at the present moment of last year's range. Now, why would it be significant, important for us to bear that in mind? Well, it means if we see a setup in here, bearish setup, we're confident to take the trade on a lower time frame and keep that in view, because that's a magnet. The market would like to, or the bulls would like to make sure the year closes above the 50% pullback at least, so they control the range for the year. The bears, of course, would want to close beneath that and say, well, with a big range, you came back to 50% pullback and we closed beneath it, so setting up for next year. So now we're in the proximity of it. It's a key level of support if it's bearish, or resistance if it's bullish. Okay. So here's what is interesting. I do not have it on today's watch list, but if we make the assumption that the day is going to close near its low, okay, as an inside candle, or close beneath it as a strong bearish candle, this is the magnet that we're talking about. Tomorrow, I would be comfortable to put it on my watch list, on my execution list. So today it's on my watch list. I'm looking at it. I'm interested to see how the day closes, because that's going to tell me, hey, George, look and execute off the 5 minute. And once it goes on to execution, just mark the low of the day, high of yesterday, 50% pullback. Then I don't come back to the daily time frame. I start to look for ways to get into the market, on the 5 minute time frame. So I'm going to come back to look at this towards the end of the day, towards the end of the American session. Now, what I'm looking for is setups on the daily chart that I would trade if I was trading the daily chart. Okay, and if I clearly see the setup, and let's find an easy one. Okay, there is a pretty easy one. Okay, so this an exam that I would pass. A pretty easy one. Okay, breakout, pullback, low one of the 10 EMA. So if I hadn't picked up that trade or that inside, or if I hadn't put this on my execution chart list, I would have missed all of this, and I don't want to jump in after that. Okay, so, and the reason I do that is I've kind of shifted from just scalping off the 5 minute time frame where you just open the chart and trade it, which you can do quite successfully, because it doesn't suit my style. I wanna find these potential trades, which I'm 100% certain 60% of the time that they'll go my way. There's always the other side. Anything can fail. That could have failed. That could have failed. But if I see a setup like that, then I get up early. I'm in Central Africa, so just 2 hours off GMT. I can get up and trade the Asian session and hopefully catch up at the beginning or at the beginning. So you don't get many of those, 3-4 in a month out of a chart, but you got 7 markets. There's plenty of opportunity. So the reason I'm saying that, guys, it's worthwhile to wait, because if you can wait and if you can catch it, it's easy for you well, it's not easy, but you can hold your trades for long. It's not easy because of the psychology behind it that you got to develop to hold your trade through swings and maximize the return. Also means if you're able to execute your take profit, you're trailing your stop at technical levels, you can hold the early trade as long as possible, if possible to the end of the day. If there's no reversal during the day, but also during the day, you can build positions and take a lot more profits along the way. So it's worthwhile. Point is worthwhile to wait. Even say that, if you trade in 5 minutes, you could just open your charts and look for opportunities. They will be there, plenty of them, but you have to think and trade as a scalper, because there are plenty of reversals as well during the day, 60% of the time. Sometimes you get strong trends and breakouts that carry on throughout the day. Okay, so I'm going to be coming back to look at gold. What's interesting, just while we're at it, to see how price has created that resistance level, bouncing off that. And we have this ascending trend line. So this is breakout mode. You could also do this. Okay. Why is it breakout mode? Because at some point, price is going to, if we don't get a breakout in the early stages, I don't know whether that will be still this year or into next year, but at some point, if price carries on going sideways, I mean, the market is not going to end up as a straight line. So there will be breakout retest chance for you or breakout retest chance for you. So it's worthwhile just to keep an eagle eye on what's happening. US 500, always interesting. They call it US 500, but it's 505 companies, largest publicly traded companies. Spoke about this, I think, in Jeff's show as well. But last week, we spoke about this level here, all-time high. That's what it was last week when we were speaking. And this week, a new all-time high has been created. But attempt to break above it failed. That doji, the trading range, should have given you any alert to be careful to take any trades here. Now, this kind of illustrates a bit of the point I'm talking about. So whenever you see a trading range, guys, whenever you see it, doesn't matter whether it's one candle or multiple candles, that's a trading range. Okay. Just a little bit. Yeah, almost. Okay. I know it's a little bit extended. I have that candle and that candle, that's a trading range. So it's almost, to the point where the market bounced off yesterday. So do not ignore these trading ranges. So if you see it, and then you see a bull candle and say, oh, I'm going to see the bull candle, I'm going to jump into it. You're forgetting the primary rule with trading ranges and breakouts. The market always tries to break out, but most breakouts fail. Whenever I see a trading range, it indicates an area of agreement. So the market breaks out above it. Chances are 60% of the chance of breakout is going to fail. So if you just jumped in and say, okay, let me put an order within there, whether it's on this time frame or later, now if you wonder, what do I do? Okay, but if that has happened, and if you have taken the trade and realize, oops, mistake, your stop is still way down here, you must just get out of it. We don't trade on hope, we trade on the price action that is unfolding before us. Okay. So no surprise in terms of new time, all-time high, but failed breakout above that high, and now we have a trading range created. So there is nothing for us to drill down, look for trades here. It's going to be just numerous reversals, and we don't want to be stuck with trading numerous reversals. When would I do a limit order over waiting for a market entry? Okay, so David, good question. Let me just find something on this time frame, on this chart, that can help us illustrate that. Okay, yes, I'm just going to use this to clarify. So the question is, when would I use a limit order instead of market order, instead of placing a stop order, buy stop or sell stop? So let's say you are down here and you're saying, okay, I know we spoke about it. There is a trend line break. When you've seen a trend line break, you've seen bear breakout, follow through, and you're saying, okay, bears are strong enough, they've broken beneath the trend line, the market didn't turn here, they're following through. So I expect there to be one more push down, leg one, pull back, leg two. So when you see this price action and you see these tails developing as the market tries to break above the 10 EMA, and then you see that low test entry, but your thesis is that because of this strength, that lower high is going to hold. Okay, so then you have two choices. You can say, I'm certain that there are sellers in the market within this region because of that strength. So if there are sellers within the market, within that region, anytime that the market tries to get above that, it's going to be met by resistance from sellers. In that case, whenever price breaks above here, anywhere within here, I'm going to put a limit order to sell. Okay. In other words, the market is going against me, it's going up, but I'm telling the broker, execute my sell trade because I am confident that the market is going to go my direction. So all you got to decide is where do you put your stop. You might say, I'm going to put my stop above all-time high. So then you just place an order above that, limit order to sell. Okay. You'd have been triggered as the market goes above that, but your stop is here and you're fine with it. So you triggered during the day, this particular day, and then eventually it comes back to the, you could have, then someone else might have said, okay, same thesis, bears and control, low, high, etc. But I'm not going to use limit orders. I'm not comfortable with them because if you're using a limit order, one of the assumptions is if the market goes against you and you're triggered, pulls back and goes against you again, you are just going to leave it and rely on your stop. Okay, you can't be using limit orders and then when it goes above you, you come out of the trade because it can turn in your direction. Okay, so use an appropriate stop or wider stop and then just hold it. Or you could say, okay, I don't want to do that. My thesis is correct. I'm going to wait for a decent entry signal. So you get that. There you put a sell stop, there's your sell order beneath that. And you send to the broker, when the market breaks beneath that, then I'm confident the market is going in my direction, so trigger me into the sell. So that's a difference that you'd use it for. Okay. So currently what we are looking at is the S&P 500. That's the US 500, top 505 publicly traded. It's an index in the US. So I think I kind of explained, and let me do that quickly. So I trade the 7 markets that are representative, in my view, of the lion's share, if you like, the largest share of the daily traded volumes in the financial markets. Euro versus the dollar, of course, 2 economies, European Union and the US economy, gold and oil, precious commodities, top 505 companies in the UK, top 100 companies, top 500 companies in the US, that's S&P 500, FTSE 100, UK 100, top 100 publicly traded companies in the UK, Brent crude oil, Hang Seng Index, Hong Kong 50, top 50 companies traded in Hong Kong on the Hong Kong Stock Exchange. That's where I'm looking for a trade setup, and we'll drill onto that just now. And then the Japan 225, Nikkei 225, top 225 companies traded in Japan. So as you can see, fairly representative. Different, charts, and so there is never any rush with the way I'm approaching the markets. You look for the setup on the daily, that I'll trade on the daily, and then when that sets up, then we just drill down to the 5-minute, look for our trades, and we'll pick it up from there. UK 500. Okay, so why would we not be trying to jump into trades here? Okay, we've spoken about that level of resistance past couple of weeks, but you can see what happened. Market tried to break above that, failed to break above it. What is the symbol for the, okay, so this on my broker is JPN 225. So you can search, I don't know what your broker calls, Japan 225 or Nikkei 225, that's the correct name. Nikkei, Nikkei 225. That's the name. So my broker has got that, but I can also see the Nikkei 225 index. So the market tried to break above this level of resistance, which we've kind of looked at quite a few times. Okay, and we spoke about it being the breakout point beneath, when the COVID bear trend started. Market is trying to break above that and fails a key level of resistance. But what we saw happening last week, an attempt to break above it, failed. A breakout is only successful. You can see a breakout candle like this one. But then I want to see a follow-through candle. Otherwise, most breakouts fail and there's nothing for us to do. Okay, so that failed, we created a trading range, and whenever you see a trading range, remember guys, whatever you see on this chart or any chart repeats itself. So you will see these patterns on any chart you are trading in, on any time frame that you're trading. Okay, so trading range, now you know any breakout it fails. So if the bulls are strong, they want to get to that. That's the magnet, that's the measured move of the height of the trading range. So having seen that, I said, oh, fantastic. Bulls, just give me one more candle, whatever size. Okay. Then after that, I want to see a pullback and then look to go long to that level. But we did not get that. So I'm eliminating this. Now, if you trade in, let's say the 15-minute time frame, you can use the same kind of selection criteria. You can use the daily time frame, you can use the 4-hourly, whatever time frame you use, just to give you that edge to select out the trades that don't meet your criteria, and then drill down and trade what you're not trading. That optimizes your returns. Okay, Brent crude oil. I think, did I mention? Okay. Interesting thing about the UK 100 very quickly, high of last year, low of last year, and you can see this is a low of this year. I haven't drawn the black line here to indicate the high of this year, but this is the level out here. Okay, that so this is the level here. Okay, so we could do that, but just for clarity, because you're trading right there. So if I did that, so it's purely for clarity that I don't have it. Because then I've got to be shifting it every day, you see, because that's the present high. So I don't want to do that. Okay, I'll just delete it. I should have just changed it. Okay, so that's the level of resistance that we're talking about. But the market, you know, the market is well inside last year. So if you look at S&P 500, way above, that's US index, way above the high of last year. And this was the midpoint of last year. Now we've broken above that. Measured move is way above there. So this bullish strength is likely to continue. If we break above this high, all the bulls want to do is put a measured move. So that trading range that's been created, high, low, okay, that when it broke out or broke below that strong bull trend line, if you're a bull, you're saying, okay, where to take profits, but now where's our target? Our target is up here, which is a measured move of that. And all it means, if you do get a decent setup, we don't have as yet, okay? So there's no, I mean, just have to be patient if you're a bull, okay, until you see a strong enough breakout pullback. If you don't see that, then it's just a failed breakout of that trading range, that high and that low. And the bears might just come back and put a couple of strong bear trend bars into the close of the month, in which case bears now will be looking for a lower high. Okay, slightly higher low, higher high, and the bears just need a lower high. If they give us 2 successive candles here, and then we might get another trading range continuation, because now we are in a trading range. Okay, Brent crude oil. Very strong market. Okay, how far is it likely to go? Well, we broke above last year, came back into it, failed, break below it, came back again, created a higher low with that higher low, lower high, then the market resumed again. And if the bulls that want to jump in, breakout, pull back, found an entry within here. But the point is, anytime you see that kind of market, that micro channel, That's a tight bull trend. That indicates, although there are pullbacks, which are profit taking or attempts to make it fail, every time we get a bear candle, get a bull candle, bear candle, bull candle. That means it's a very strong trend, and all of this is most likely profit taking. So in order for this to reverse completely, even if we have a break beneath this, chances are the market will resume a little bit more. Where is the goal presently for oil? The goal is in the 92 kind of range. And how do I come up with that? That trading range, which you can see quite distinctly, that high, that low, breakout above it, measured move. That's where the market wants to go. So how do you trade the market like this? If you wanted to trade this, only way is, where do you put your stop? Your stop always has to be at a technical level. And the best place to put your stop on a tight bull channel is to just go back to your left. You could put your stop there or your stop here. Okay, so it's quite a ways down, but that's because all that's left in terms of the measured move is that. So if you want to take that and you put your stop here, you might get at less than 1-to-1. Your choice if you want to do that, but there is no room for us to, there's so many reversals, as you can see, to trade comfortably. You can trade any market, but the goal is to trade comfortably and make our money without so much stress. So we leave it on the chart, on our watch list. Okay, let me look at the Nikkei 225. Okay, there says Nikkei there, or Japan 225. I'll come back to the Hong Kong 50 and tell you where I am looking for trades. Okay, so Nikkei 225, high of last year, the blue, low of last year, you can see market broke above that. But what happened to the bulls? We've just ended up in a trading range since the market broke above that. We just ended up in a trading range. If you think of that trading range and say, well, what is the most significant price level within that trading range? We have double top up here, we have a double bottom down here, another smaller double bottom here. The height of that trading range, you get a 50% pullback. That 50% pullback is a key area, key level in the market. So somewhere within that level. So this year's trading range, we broke above last year, so we broke about the 50% mark. Okay. So if we're right on the 50% level, what would we do with this? It's not on today's list, but tomorrow, if today ends up as a strong bear candle, okay, primarily closing beneath this bull candle here, strong bear candle, we still got the 50% pullback, whether it's on it or just below it. And that means the bears are saying, okay, we had. So if you're looking at the market, while we're in a trading range, but look at that, what's the most significant price action to the left presently? There is a significant price action to the left. Okay, an attempt by the bulls to get back into the last year's range, failed. Again, the bulls tried to resume, but there's no strength here as far as the bulls are concerned. Now we end up with a lower high. And if we had with a lower high, whenever we see a setup, a lower high, well, you can mark it from that high to that low, or there's a decent lower high there. That could also be it, but still a lower high. Then what you gotta wait for is our setup. Okay, we don't trade this one. We wanna wait to see if we get that setup. At this point, that failed to break out beneath that micro double bottom. So that's where we're gonna watch this to see if we'd had a big bull reversal candle. But for tomorrow, if we close on the low, I don't want a dodgy candle. If I get a dodgy, I'm not interested. But if we close on the low, that immediately goes onto my execution list. When I look at it later on tonight, probably with an hour or two to go before the US session closes, just to give me a sense of whether I should get up early or not. If I see it closing on or near its low, then I'm interested to get up and see if I can find a short entry. And of course, I'll put the appropriate stop on the 5-minute time frame. But there is a key magnet. Potential area of a bounce or reversal during the day will be down here, but I'll be trying to hold it if we get the setup as far as we can. We might get a big candle, okay, which would be worthwhile for you to have waited for that. So that's one that I'm definitely look at before the end of the day. Now, let's have a look at Hong Kong 50. This is a very interesting market. I've put some stuff here, which I just need to take out because when I go into the daily, I'll put it back on when I come back. It's going to clutter a few things. Because I want to show you what's happening on the daily that made me move this from just purely watch list to execution. Okay, and it's still a little bit messy. I just want you to, okay, that can work. Now, I was speaking to Jeff the other day, Jeff's show, Live Trading Buddies, and I had mentioned that this is on my watch list. Okay, so this is the present pattern that we're looking at yesterday's. But when I looked at it, I was saying this was on my watch list for a sell. And the reason I say it was a sell is because of the tight trading range that we have. Okay, we still have this lower high and this high, this lower high, and we have this acceleration down here. Okay, so the red and the green, red low of yesterday, green high of yesterday, I put that in when I'm moving a chart from a watch list to execution. So I put that to execution. Now, what I put it onto execution for is not as a sell. Okay, when I saw this big outside candle even formed towards the end of the day yesterday, right as a double bottom here, my view was we are at the bottom of a trading range, just like when we're here, we were at the top of a trading range. And when we are here, my view was, hang on a second, we're right at the top of a trading range. Look, 3 candles have bounced off a level, which is that light blue line, which I put in there. So the green is yesterday's high. So I was saying in that area, that's likely to turn for us. You can't expect, I wasn't expecting a higher probability of a bull breakout, pull back and go. So higher probability was a bear candle, was selling off the top of the high. The market opened with a gap up, and I'm going to show you that. Then it just traded all the way down. So we're going to look at that and see how you'd have traded that with the expectation of bear. So that expectation was correct, but what unfolded is interesting in terms of its difficulty. But then, okay, I got a question, I'll look at it just now. Then coming into today, now I have a trade range at the top, trade range at the bottom, and I'm expecting that this breakout will fail, and I'm looking for longs at the bottom of the trading range. Doesn't look like it's giving that up at the moment, but I want to show you what was setting up and what I was waiting for and what I'm still waiting for. Let me just have a quick look at our question. Excellent. Okay, brilliant. All right, guys. So I haven't looked at that. Now let's look. So keep that in mind. Let's go to the 5-minute time frame. Okay, so what I want to show first before I look at how yesterday unfolded is that is the low of yesterday. And that's the high of yesterday. So our trading range is within this, these highs and these lows. So in getting up and looking at the market, I was looking for a failed breakout beneath this because I'm thinking trading range. You always buy at the bottom of a trading range. We opened up with a reasonably large bear candle, opened up here. That magenta line is open, pulled back to test, and then came back. And I thought, let's see if my thesis is correct. There will be it's going to be a failed breakout at some point. So I'm still holding on to trading from the bottom of a trading range and looking to go long. So this trading range price action was an opportunity for the bears. If the bears were strong, it was an opportunity for them to put successive candles. Okay, so if the bears were strong at that particular point, okay, if the bears were strong, instead of us having dodges inside, dodgy buying at the bottom, etc., all of that have been strong bear strength. So I'm still holding on to my thesis that I'm looking for ways to go long if it sets up for me. So now a trading range was created, and whenever you see a trading range, okay, low of the trading range, high of the trading range. So I'm saying whatever price action forms, the market should tend there. And indeed, while we had that high test candle, there's no ways I would have traded that because that's essentially in the middle of the trading range. The way it looks afterwards is that, if you trade that and put your stop in the correct place, you would have probably made just less than 1-to-1. But in any case, so the market's turned here. So now I'm saying, okay, fantastic. That move right from the open, first leg, pullback, second leg, has ended here. So I got to wait now to see if after the end of the move, I get a setup that is tradable. So I always look for the end of the move, which was that low. And then you literally just got to wait. So what we then had after that was a double bottom, but that being the end of my move, I start counting the double bottom of any forming trading range after the move. So I was keen at that stage to see if the market would come back and give me a double bottom. And if it did, then I want to wait to see a tradable higher low. What we got instead was a slightly higher low double bottom. So fantastic. So at this particular stage, I'm very happy with what is unfolded before me. I have the end of that opening move. I have a double bottom that is formed. Now I'm waiting to see if I get a higher low that I can trade. Now, while all of this is forming, something else is forming. There's always two sides to the equation. So we had, after the end of the move, we had the test of the 10 EMA. Remember, I use the 10 EMA to indicate the strength of the bear trend, and a resumption of the trend, which is what you can expect. Then we had the lower high, okay, after that, that new low. Then we had another slightly higher low, high after this, but still a lower high after that. So a trend line is forming for me, which is very important for me to determine where I'm going to be taking my higher low entry. So if I just extend that, at one point I had it there. Okay, so slight overshoot, and I'm still waiting. Then I get my higher low double bottom. So fantastic. Now I got to wait to see the higher low that I trade. And the higher low that I trade has to break above that trend line. So that's perfect, absolutely perfect setup. I'm now just waiting to see how to get it. What would I have wanted to see? What would I have expected to see? I talk of separation. After you see a setup, I need to see at least 6 candles, so I allow enough time for price action to form. So I wouldn't have traded that in any case, even if you had set up and back. But they haven't seen that, happy. Now we have a higher low after that particular double bottom, but I still haven't broken above that trend line. So we've seen this price action, very happy with that. I wanted to see just a break above that, be it 1 or 2 candles, and a bounce to come and bounce off that. Then I would have put my entry above that. But instead, we didn't. The breakout came here. So good breakout candle follow through. And having seen that, then I was expecting a reversal, strong bear candle, but I would have wanted to see just a decent low test candle, and I would have put an order beneath that. But nothing is set up above there. Then we went into the close of that particular session. The only thing to bear in mind when trading the Hang Seng 50 is a different closure time. So don't be surprised when it closes. Just be aware of when the market might close and reopen again. So we didn't get triggered into that. If we had set up correctly, our stop would have been here, and hopefully would have had acceleration. But so far, there is nothing. Now, have I changed my bias completely? Only in so far as instead of looking for a bull, strong bull breakout back into that, now we are clearly in a trading range. So in my mind, all I'm seeing now is a trading range. And if I see a trading range, I'm going to wait to see if I get a decent setup here. Okay, a little breakup, pull back, and I'll only be going as far as that trading range, as the top of the trading range. Okay, and if I then see a sell setup here, if I'm still in the market, I'm going to look to sell it back because the market has transitioned into a trading range, and the failed breakout I was looking for, that's what I was looking for, a tail on the day and acceleration back. So just part of the game of waiting. Now, just quickly, so that's today, but I want to show you the setup as it appeared for yesterday. I think you might find this interesting. Okay, so remember on the previous, when I was looking at the dailies, I had that level indicating the upper level of the 3-day trading range. Okay, this is a high of yesterday for today's trading. Now, what happened is expecting that at the top of the trading range you sell. Okay, that would have been the high of the day, but you wake up with a gap up because of the closures and openings. Fantastic. And the first candle that you see is a bear candle. Absolutely great, because I'm expecting that's the top of the trading range. Didn't expect a gap up, but you got a gap up. Now you got to wait to get confirmation that the thesis around the bears is strong. Okay, we have a dodgy inside candle, bit of a pause after the open. Then we have decent and strong enough bear selling. And once I see that, I'm comfortable to look for ways to trade this market. Now, you're gonna wait for the pullback. If you sell at the market, your stop has to be out there. But it's best to wait for pullbacks. Now, earlier on, I think it was one of the guys asked for when do you use a limit order and when do you use a market order. So if you've done the analysis and assessment that I took us through, and your thinking was, we're at the top of a trading range, I'm waking up tomorrow looking for ways to go short on this particular market. We have a gap up, we have a follow through, and say, okay, fantastic, bears and control. But I don't want to put an order somewhere down here. There's likely to be a pullback. Where am I gonna place my limit order to sell? Then you just go above this candle, put your limit order above there. Okay, it might not have been triggered if it turned here, but in this case, you'd have been triggered. And if you didn't, let's say you didn't get triggered into that, and you're still happy with the bear case, you're saying, okay, I've got to wait to see there's a bear, another bear breakout beneath that, dodgy, but still bear follow through. Then I have a bull candle. I don't want to wait to put an order beneath a bear candle. My thesis is still right. I know where my stop will go. If you know where your stop will go, then because you want to use your limit orders, you put a limit order above this bull candle, because you just say it's a pullback. I know the pullback will fail because my thesis is that the bears are strong enough. Okay, so that's where you'd put your limit order. So stop has to be up there. Okay, so limit order guys can get in a little bit earlier. If you're comfortable to use limit orders, I prefer to use stops, sell stops. I like the market to be going in my direction. Every now and then I've used it, and they work well if you know where your stop is, and if you're comfortable sit through a deep pullback. Absolutely fantastic. Get in early, get more profit. Alternatively, you wait, you could put your entry beneath this if you wanted, or you can say, well, let me wait and see if I get another tighter entry. All of these, with all these tails, are entries that you could have used or entries that you could have used. Unfortunately, when you're taking trades up to here, the pullback, your stop is going to be up there. Okay, if you think the stop is too far, the only other legitimate place to put your stop would be a 50% pullback. Okay, so that would be slightly above those candles. If you want to be a little bit more aggressive, when I do that, I just drop from my 1% risk and I go 0.5% risk because I know my stop is a little bit aggressive. So if I get stopped out, I'm comfortable with that. Okay, so we've got to manage our time today, guys, but let me just point out with the mindset that I'm trying to put across to you that if you see the if you analyze your daily time frames and find entries that you would trade off the daily time frame, then you go down to your 5-minute time frame and find the entries, you'll have a tighter stop, but the objective is not just a tighter stop than a daily entry. The objective is going to be to try and hold these trades through all the swings in the day. Okay, which means that first trade that you take is very important. Take your tip, some TP1 off and manage your stop, etc. But try and hold it as much as you can. Okay, so you take your trade and your stop is up there on that first trade. Just try and hold that first trade as far as you can, because if you're right, you get good profits. But if you can't hold through it, well, you take your profits, then you look to jump in again. So here, you have stayed in the market, you've done your measured moves, you've expected to take profits there, either take some profits off. If you've trailed your stop at some point, you might have been stopped out. You could also trade this long legitimately if you're not holding your trades. And then major trend break, which we've spoken about, there is a trading range. But ultimately, whether you had entered anywhere in here or in here legitimate, your stop should have been there. Okay, you have had to hold your stop. There's no reason to tighten your stop until we're down here. So any trades you have analyzed in here is after this lower high, perfectly legitimate. One stop up there, you wouldn't have been stopped out. If for any reason you kind of stopped yourself out, you've got to keep looking at the market and jump in again. Many opportunities to have taken a trade. Right up there, breakout, pull back, you could take that, you could take that. There's many ways you could have traded this yesterday. All